A retired software engineer in Massachusetts opened his Medicare statement in January and stared at it for a full minute before he understood what he was looking at. His name was Robert. He was 68 years old. He had retired at 66 after 34 years at the same firm. And the letter in his hand said his Medicare Part B premium for the year was going to be $628 a month, not the standard $185 everybody else on Medicare was paying. $628. His wife Linda got the same letter on the same day. Together, they were going to pay almost $15,000 in Medicare premiums that year. Robert called the Social Security Administration 3 times that week trying to figure out what he had done wrong. He had not done anything wrong. He had crossed a line he did not know existed by $1,200. And the mistake he made, with the best intentions in the world, is the same mistake millions of retirees are making right now, because nobody is telling them where the line is, how it works, or how to get on the right side of it. Here is what happened to Robert and Linda, and here is exactly how you make sure it never happens to you. This video is for educational purposes only and is not tax or financial advice. Consult a qualified professional before making any decisions about your specific situation. My name is Paul Merrick, and this is Don't Die Broke. I spent more than 20 years as a certified financial planner watching good people make avoidable mistakes that cost them everything they worked for. Every week on this channel, I break down the tax rules, the financial traps, and the strategies that protect retirees from the things nobody else is explaining. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Let me explain what Robert ran into, because if you are on Medicare or you are about to be on Medicare, this is going to happen to you in some form. It is called the Income-Related Monthly Adjustment Amount. The shorthand is IRMAA, and from here on, I am going to call it the Medicare surcharge, because that is what it actually is. The Medicare surcharge is an extra amount the Social Security Administration tacks on to your Medicare Part B premium and your Medicare Part D prescription drug premium if your income crosses certain thresholds. In the year 2026, if you are single and your modified adjusted gross income is $109,000 or less, you pay the standard Medicare Part B premium of $185 a month. If you are married filing jointly and your combined modified adjusted gross income is $218,000 or less, you both pay that standard premium. $1 over those thresholds and you stop paying the standard premium. You get bumped up into the first surcharge tier. And here is where most retirees get blindsided. This is not a graduated tax. This is not a marginal rate. This is a cliff. If you are $1 over the line, you pay the full surcharge for that tier, not a proportion of it, the full surcharge. There is no grace zone, there is no phase in, there is no rounding down. $1 over and the entire tier applies to you for the entire year. Let me put a dollar amount on this so you understand the stakes. The Medicare surcharge has 5 tiers above the standard premium. Tier 1 kicks in at that $109,000 modified adjusted gross income threshold for singles and $218,000 for couples, and it adds roughly $74 a month to your Part B premium, plus another $13 and change to your Part D. Tier 2 adds roughly $185 to Part B. Tier 3 adds roughly $296. Tier 4 adds roughly $407, and the top tier, Tier 5, adds roughly $443 a month to your Part B premium, on top of whatever you already pay for the drug portion. That top tier in 2026 works out to an extra $6,936 per person per year on top of the standard Medicare premium. For a married couple, that is almost $14,000 a year in surcharges. And that is money that comes out of your Social Security check before it ever lands in your bank account. Now here is where it gets critical, and this is the part Robert did not understand until it was too late. The Social Security Administration does not look at your income from this year when they set your premium. They do not look at last year either. They look at the tax return you filed 2 years ago. That is the 2-year look-back rule. In the year 2026, your Medicare surcharge is determined by the modified adjusted gross income on the tax return you filed in 2025, which reports your income from 2024. So when Robert did his big Roth conversion in 2024, which, by the way, his financial advisor told him was a smart move for long-term tax planning, he had no idea that same conversion was going to show up on his Medicare bill 2 years later. He was thinking about income tax. He was not thinking about Medicare. Nobody told him the 2-year look-back existed. His advisor collected a fee every year for 12 years and never mentioned this once. Scenario 1. Sarah and David retired at 65 in a suburb of Denver, Colorado. He was a civil engineer, she was a paralegal. Their combined Social Security is roughly $52,000 a year. They have a joint individual retirement account balance of about $900,000. In 2024, their first full year of required minimum distributions was still 9 years away because of the Secure 2.0 Act rules, but they pulled $40,000 out of their IRA to pay off a home equity loan. On top of that, they had $90,000 in long-term capital gains from selling some stock. Their modified adjusted gross income for the year came in at $219,000, $1,000 over the joint threshold. That $1,000 pushed them into Tier 1 of the Medicare surcharge. For the year 2026, each of them paid an extra roughly $1,048 in Part B and Part D surcharges. Combined, that $1,000 miscalculation cost them more than $2,000 in higher Medicare premiums. If they had sold 10 fewer shares of that stock, if they had pulled $1,000 less out of the IRA, they would have paid 0 surcharge. Same couple, same year. Same Medicare coverage, $1,000 on the wrong side of the line cost them over $2,000 in extra premiums. Scenario 2. A retired cardiologist in Naples, Florida. 71 years old, widowed, lives alone. Her name was Margaret. Her required minimum distributions from her individual retirement account alone were $140,000 that year. Her pension paid her another $62,000. Her Social Security added $34,000. She had municipal bond interest of $18,000 that she thought was tax-free. She had some dividends and interest on top of that. Her modified adjusted gross income for the year landed at roughly $278,000. That put her into the Tier 3 surcharge bracket as a single filer. Her Medicare Part B premium for the year jumped from the standard $185 to around $591 a month. Add the Part D surcharge on top of that, Margaret was paying more than $7,000 a year just in Medicare surcharges on top of her regular premiums. And here is the trap inside the trap. The municipal bond interest she thought was tax-free for federal income tax purposes, not excluded from modified adjusted gross income for Medicare surcharge purposes. Tax-exempt interest gets added right back in. Her bond portfolio was pushing her into a higher surcharge tier, and she did not know it, because the word tax-free does not mean what most retirees think it means when it comes to Medicare. Scenario 3. James, 67, retired police sergeant in Pennsylvania. Pension of $48,000, Social Security of $31,000, a modest IRA he was not yet tapping. His wife Rachel had passed away 18 months earlier after a long illness. In the year he lost her, his filing status changed from married filing jointly to single. Same income, same pension, same Social Security. But the thresholds for a single filer are half what they are for a couple. The year Rachel died, James was still filing jointly. The year after, he was filing single. His combined income stayed almost exactly the same. and he got hit with a Medicare surcharge for the first time in his life. This is the widow's tax nobody warns you about. When a spouse dies, the surviving spouse is almost always pushed into a higher tax bracket and into Medicare surcharge territory because the threshold's cut in half while the income stays roughly the same. James called Social Security to ask why his premium had jumped. The agent on the phone read from a script. He told James the income on his tax return from 2 years ago put him in a higher bracket. The agent did not tell him he could file an appeal. Here is where the trap closes, and here is the part of this video I want you to pay very close attention to. The Social Security Administration has a form called SSA-44. It is called the Life Changing Event Form. If you've experienced what the agency calls a qualifying life-changing event, you can appeal the Medicare surcharge and have it recalculated based on your current income instead of your income from 2 years ago. The qualifying events include the death of a spouse, marriage, divorce, work stoppage, work reduction, loss of income-producing property, loss of pension income, and employer settlement payment. Retirement itself counts as work stoppage. If you retired in 2025 and your 2024 tax return still shows your full working year income, you can file Form SSA-44 and ask the agency to use your current, lower, retired income instead. James did not know this form existed. Robert did not know this form existed. Nobody calls you and tells you it exists. You have to download it yourself from the Social Security Administration website, fill it out, attach documentation of the qualifying event, and submit it to your local Social Security field office. When James finally learned about it 8 months after his wife's death, he filed the form and got his surcharge dropped from Tier 2 back to the standard premium. He recovered nothing for the months he had already overpaid. The appeal is not retroactive beyond a certain point. You have to act. Now, here's what makes this different from anything that came before it. There is a way to pull money out of a traditional individual retirement account to satisfy your required minimum distribution without having a single dollar of it count toward your modified adjusted gross income for Medicare purposes. It is called a qualified charitable distribution, or QCD. If you are 70 and a half or older, you can direct up to $108,000 in 2026 directly from your IRA to a qualified charity. The money counts toward your required minimum distribution. It satisfies the mandatory withdrawal requirement, but because it goes straight to the charity and never passes through your hands, it does not show up as income on your tax return. It does not count toward modified adjusted gross income. It does not push you into a Medicare surcharge tier. Margaret, the cardiologist I mentioned earlier, could have directed $40,000 of her $140,000 required minimum distribution to the charities she already gave to every year anyway. That would have dropped her modified adjusted gross income by $40,000. It would have moved her from Tier 3 down to Tier 1. It would have saved her more than $5,000 a year in Medicare surcharges, plus whatever it saved her on her federal income tax. Her tax preparer filed her return every year and never suggested it. Her brokerage firm knew she was over 70 and a half and had a charitable giving history and never flagged it. This is how the system works, or does not work, depending on how you look at it. Here is your action checklist. 1. Find out exactly what your modified adjusted gross income was on the tax return you filed this year for the tax year 2024. That is the number the Social Security Administration is using to set your 2026 Medicare premium. If that number is close to $109,000 for single or $218,000 for joint, you are in the danger zone. 2. If you have experienced a qualifying life-changing event, you retired, your spouse died, you got divorced, your pension stopped, you lost investment property income, download Form SSA-44 from the Social Security Administration website today. Fill it out, submit it to your local field office with documentation. 3. If you are 70 and a half or older and you give to charity, stop writing checks from your bank account. Have your IRA custodian send a qualified charitable distribution directly to the charity instead. Every dollar you send that way is $1 off your modified adjusted gross income. 4. If you hold municipal bonds in a taxable brokerage account, understand that the interest is tax-free for federal income tax, but is included in your modified adjusted gross income for Medicare surcharge purposes. Run the math on whether they still make sense for you. 5. If you are considering a Roth conversion, talk to your tax preparer about the 2-year Medicare lookback before you pull the trigger. A $40,000 Roth conversion in a year where you are already near a threshold can cost you $3,000 to $5,000 in Medicare surcharges 2 years later that nobody warned you about. 6. Request an estimate from your tax preparer in November of every year. Have them project your modified adjusted gross income for the year based on what has already happened. If you are within a few $1,000s of a threshold, there is still time to adjust. Skip the final capital gain, delay a distribution, make a qualified charitable distribution, max out a deductible contribution. 7. If you are married, plan for the widow's tax. Run the math on what your surcharge tier becomes if one of you dies and the survivor files single. That future tier should factor into every decision you make about Roth conversions, asset location, and how you draw down retirement accounts today. 8. Check the Social Security Administration's published thresholds every November. They adjust for inflation every year. What was $103,000 in 2024 became $106,000 in 2025 and $109,000 in 2026. Know your number. 9. Keep all documentation of life-changing events. The death certificate, the retirement date letter from your employer, the divorce decree, the pension termination letter. The Social Security Administration will ask for them when you appeal. Let me run the math one more time in plain words. At the top Medicare surcharge tier, one person pays an extra $6,936 a year. A married couple in that top tier pays almost $14,000 a year. Over a 20-year retirement, that is $280,000 in surcharges alone for a couple that never appealed, never used the qualified charitable distribution, never knew the thresholds existed. $1 over the line, 2 years of look back, 5 tiers of surcharge. That is not a loophole the wealthy exploit. That is a penalty the middle class pays because nobody explains the rules. This is how people die broke, not from a stock market crash, from a Medicare surcharge bill that drains $14,000 a year out of their Social Security checks because they crossed the threshold they did not know existed. This is Paul Merrick, and this has been Don't Die Broke. If this video helped you, hit the like button right now. It takes 1 second, and it helps this video reach more retirees who need to hear it. If you are not subscribed yet, hit subscribe and turn on the bell so you do not miss the next one. If you know someone on Medicare or someone about to turn 65 who has a decent retirement income, send them this video today. It might save them thousands of dollars in surcharges they have no idea are coming. And leave me a comment below. Have you ever filed Form SSA-44? And did the Social Security Administration approve your appeal? Yes or no, and tell me what happened. I read every single one, and the most common questions become future videos. I will see you in the next.